Welcome back. How's everybody doing? I know it's been a little while, but in this video, I'm going to be going over my oil hedge trade that I actually shared around 3 months ago, right here. And this video is going to be an update of that hedge and how I'm using this hedge for my capital preservation for my overall portfolio, and just giving you guys just an update what to look for if you want to follow me on this hedge play for my own portfolio. It does not mean you have to do this, but it makes sense for me. And later on, I'm going to go over my thesis and what fundamentals and why, to give you more understanding on my logic and not just I think it's gonna go this way because oil looks bullish, because it does look bullish, but I want to put more weight into that sentiment rather than just how the chart looks. At this moment in time, I think we could all agree that the market is getting away from being news-based or sentiment-based, as in headlines or certain events that are dropping, the market moves, because they have been lying to us and we lost trust in them. The average investor doesn't believe when there's a ceasefire, and even right now, if you look, they're still firing missiles. Ceasefires are being broken left and right. It just keeps on going on this cycle of saying there's peace talks, so the stock market go up, oil will go down, and a week later the ceasefire gets broken, and then oil back up, right? And one thing I'm noticing in these past few months of this war going on is that the price fluctuations of these headlines, they're making less volatile moves. It still moves the market because it's like, at the end of the day, it is the government saying it. It is a possibility, it can, but it's not moving as aggressively as it was before because they're not believing it no more. How it's looking like, in my opinion, based off how big investors are positioning their portfolios on the stock market and everything else, it's looking like the average investor is kind of in a bad way, already priced in the war pretty much. They're already kind of getting ready for this war to be dragged out, because you never know. It could be another Ukraine. It could be a war that goes on for years. You don't know. You might be saying, so what are they focusing on if it's not the news or headlines? It's now we're going back to fundamentals. People are now focusing on the interest rates. People are focusing on the actual earnings of these things, because now all this hype with AI, all this hype with everything else, the earnings are backing it. But before, just by the hype itself, people would be buying into these products. Now people are like, okay, the hype is there, the hype is gone. Now let's see the proof in the pudding, pretty much. You might be asking yourself, why oil out of all the assets to hedge my portfolio? Is that not only is oil, macroly speaking, about to switch structure, about to do a macro break of structure to the upside, but also geopolitically speaking, ceasefires are being broken. Iran is now threatening to attack America where it hurts. The billionaires are Nvidia, Apple, and others. So either two things are going to happen. Either America is going to start retaliating much more aggressively, or the war is going to be over. I'm getting the bet that this is not going to end just like that. Yes, me personally, the reason why I'm choosing this, because I am anticipating this war is going to last longer than anticipated, at least probably for the rest of this year. I don't know. At the end of the day, not financial advice. I'm just a guy doing my own research and using this platform kind of as a journal for my investment portfolio, etc. With these two reasons why I'm choosing oil for my hedge, for my portfolio, is that it is a perfect recipe for the high risk assets, as in currently at this date, the Nasdaq's come fully back, the Mag 7 are kind of struggling, but this is the perfect catalyst for a higher downturn for the high risk assets. It's not the end of the world. Now we're going into a contractionary phase into expansion. So now for the high risk, I'm going to start looking to buy more or look for investment entries. But this is why. This is all perfect recipe for for blood in the market. Cryptos already has blood in it, but the stock market has been kind of grinding along, but it hasn't seen blood yet. All this is going to cause higher inflation, and whenever investors are more focused on the macros and the data, they focus on the cost of business. Inflation goes up, the United States is going to raise their interest rates, aka the cost of business is going to be higher. So it's going to cost more money for Nvidia, Apple to do business. You know, those companies, the high tech stocks, the QQQ, most of those tech companies, they leverage money. It's not like a commodity or anything. And that's kind of like the difference between the two. That's why whenever rates get hiked, those stocks start to struggle or start to go into a contractionary phase because now they have to pay back that debt. And that's why the earnings are more important now. That's why more headlines are talking about earnings and earnings and earnings. Because now it's, if we're gonna now repay this debt or now pay this higher interest rate, we need to see that earnings back in it to see if we could even afford to pay it. I'm gonna show you guys physically what I'm talking about so you guys could visually see better on like what I mean in my thesis and why I'm taking this trade. Okay, so hopefully you can see it good right there. Okay, so if inflation's going up equals rates are going higher. If rates are going higher, that means liquidity down and the cost of business goes up. If the cost of business goes down, that means the dollar/yielding assets go up. As you can see right now, at the dollar, if we go to it right now, the dollar is slowly grinding up and it's looking like it's about to break out and start reclaiming some of these highs. Why I'm saying this, I'm giving you the pathway on why and how these high risk assets, as in your crypto, the QQQ, your techs, your Nvidia, whatever, has a chance of going on a contractionary phase as a little mini bear market, which a lot of people have been talking about, the bull bursting or whatever. And the dollar yield going up is going to tell you that investors are seeking a safe haven. But you might say, well, what does it have to do with oil? Right now, the difference is that we are in a war, and if I'm anticipating that the war is not going to end, it's going to keep going longer, and that's what is the biggest cost of the government's expenses. If the dollar is higher and it starts increasing in value, then their war premium is going to get cheaper, but it's not going to change inflation. It's going to go higher, but it's going to be cheaper for the defense-based companies and the government to continue this war. Okay, so more money going into the oil is going to be more demand for it. Plus, a lot of refineries are being destroyed. There's a lot of things even outside of just the data, just as what's happened currently so far in the war, that is going to already guarantee that oil is going to stay high for a good little minute. Like, I'm going to be honest, I don't think we're going to see any like prices under like $60 or $50. We're definitely not coming back here for a very long time. Based off just everything that's been destroyed and all the damage that's been done, I don't think we're going to take these lows for a very long time. And look, this crash started in 2008 and it took more like 10 years, 12 years to now possibly start getting a expansionary phase. Because remember, there's contraction, expansion, or accumulation. We have been just contracting all the way down for 12 years. Eventually, these people that have been buying on the way down are going to want to see a profit. Same thing works with any other asset. Why? How come not commodities, right? And talking about interest rates and the possibility of being hiked, just even look at the Fed Watch today. Let me refresh this page. Let's see what they say. Yeah, even on this, I think the FOMC was today. I think it just happened. For sure, I'm pretty sure he said something where they're not going to hike. But as you can see, when we zoom in into the later times in the year, let's say in September, they're thinking about hiking. It's getting to the point where they are anticipating at least a for sure hike. How much they're going to hike, we don't know. But a hiking is going to happen. So if we're anticipating and investors are now thinking that a hike is going to guarantee happen at least a few basis points, then this will be possibly like the perfect time for a little mini contractionary phase for a few months to because the best case scenario is that they hike not as much. They hike once or twice there, but they keep on aggressively hiking, that's when things are going to get pretty bad. Right now, it's not recession yet. I believe if they keep on going on this path of just aggressively hiking, then yes, things are gonna get pretty bad. But until then, we are gonna change our investing plan. But right now, this is what I'm seeing. And if my thesis is correct, then this is just behaviors and showing you that these investors are now looking for somewhere to park their money. And the stock market's pulling back right now. The stock market's looking shaky. And now the rates are being hiked. People are not going to go to gold and silver because remember, only time when gold really starts rallying is when they're going to start cutting because you can't get a yield on gold, right? people are going to start going to fiat. Fiat is going to be king. Cash is king. The dollar is king. It's going to take a long time to take the dollar out of that title, right? I'm not saying it's not possible, but right now, where we are right now, it's going to take a little minute. So the fact that now the rates and the yield on the dollar is getting higher and higher, and now investors are anticipating for a hike and more, and the rates and the yield getting even more aggressive, then it's obvious that now this is behavior of them switching to very low risk assets. Obviously, they're getting into energy. If you even look at energy ETFs and energy stocks, they're going up in value. Defense and medical, because medical always, because people are always sick. But right now, what's performing is energy and defense. Okay, they're not going into gold or anything else. Therefore, this is why I'm choosing this oil trade to hedge my high risk assets. I have a little extra capital on my portfolio that I haven't deployed yet, and this is why I'm deploying a little percentage. So since I am anticipating a downturn and I don't want to sell my high risk assets at a loss, I still have dry capital to buy more. So I want to use that extra capital that I have to hedge this. So on the way down, I could gain a profit and technically buy more, whatever stock or whatever high risk asset I am anticipating for the next rally up, more. I have more powder to play with. So right now we are at the platform that I'm doing this hedge on. Remember on my previous video, I think I had like $200 or $100 in margin, and I'm building this position. And the entry model that I am using for this trade is the 20-20-20-40 method. If you watch my videos, I talk about this method all the time. And right now I have $400 in margin, so I technically have one more 20% buy-in and my last 60. And yes, and then I'm gonna go over where I'm thinking about adding my last 20% and how I'm gonna deploy my last 60. All right, so right now, just to show proof, like this is oil on Hyperliquid. You know, I've been trading the fuck out of this. Now I'm in barely any profit. Position size is 1,300. Again, guys, like this is my trading bag. I have many different portfolios. This is not my main portfolio, okay? Like this is just my practice one, and then my real portfolio, I have it on more legit exchanges, not on crypto, okay? Crypto is just for fun on my crypto exchanges. Okay, so now going on to the chart, showing you what I'm seeing. All right. So as I was saying before, earlier in the video, we are macroly, this is a monthly time frame, on a downtrend, and now we're about to hit this macro high right here, possibly break structure and then flip bullishly and go higher, right? If we do flip structure and we break this high and we start finding support, because we could just range here for a bit and then break, but if we do get that break, my target will be Goldman Sachs at $120. He predicted that based off the war and the geopolitical sampler of the world right now, just like James Smith, what do you say? Yeah, it's likely that we're gonna hit 120, and plus all the damage, everything else, it's very possible. And just by looking on the chart itself, that is pretty evident. Like I could see that happening. And 120 is not that far from here. Let's say if we take the high again, 120 is right here, and then where my position is at, I am right here at like $88 is my entry, like 85 or something. I think it's like 86, I don't remember. But 120 is a solid 30-40% move, okay? But if you look higher, there's a bunch of areas of interest, because I could see us even going higher. I think Goldman Sachs is just playing it safe, but 120 is a very logical spot. Like there's even this order block right here. We could even go up here. Like there's a high chance that I believe we could see. Now let's see if there's any recovery points. We have a recovery point here. Oh damn, that's kind of hot. Hold on. Sorry. Let me get. It's hot over here in Arizona. Anyways, so even here we have a vector recovery starting at 124 to 134, even one up here on 160, and even one all the way at 188. And mind you, this is on the monthly time frame. If you anything in trading, the higher the time frame, the more weight these confluence have, because obviously there's going to be vector recoveries on the 1 minute, 2 minute, but if there's recoveries that you're targeting on the higher time frame, it's a stronger point of interest. Okay, so Goldman Sachs is playing it safe, but that is my mandatory take profit zone. I'm gonna take at least a solid more than 25% of my position. Okay, macroly speaking, we are about to break the structure, and when I back up, why is it gonna break? Because remember, price doesn't move because of the pattern or there's a wedge and this trend line broke bullish. If you could put macroeconomics and data behind why a pattern might break or why a order block might hold, it's 9 times out of 10 going to be a way better trade and a way better position to be in. So based off everything that I said, all the fundamentals, I believe we're going to break structure and then we're going to come at least attack 120 to, sorry about that, to 140. Okay, now zooming into this little mini range here, as you can see, this is that range. We're on the daily time frame. We are currently confirmed as low. This is now the high, boom, low, right? So if we are going to continue this bullish structure, because even on the weekly time frame, let's zoom out, even in this internal, we broke structure, we're clearly in an uptrend, right? Of course, if you zoom in on the 4 hour and all that, and then it could be down. I think even now the 4 hour is bullish. Let's check it out right now. Yeah, the 4 hours bullish, even flip bullish right here. Yes, we went on the downturn, so this leg will be bearish, but even in this leg, we broke structure right here. So now we are technically in a medium term bullish, probably gonna target $90. Okay, so in this internal range, we have a confirm low. Break underneath this low, then that means on the weekly time frame, we are now breaking, pretty much making an M pattern and going down lower, and likely gonna come target down an order block down here. I think that has been unmitigated. The zone from 57 to fill this gap. Fill this gap you see right here from 57 to 53, and I don't really see any other unmitigated order blocks. Obviously, I'm not going to zoom into the 1 hour or 4 hour. I only want to focus on the higher time frame. Once we get there closer, then yes. All this is ugly lows. Liquidity has not been taken. So I could see as if this does not hold, then that means either something really good happened and the war is over and we all signed an agreement, everything's going back to normal, putting a lot of money into rebuilding. Then yes, I could see us going back down there. But the last, whenever I do my structure, I want to say this, okay? So whenever I plan out my trades and I'm using the TA to find my points of interest and how I'm going to trade those points of interest. So just right now, how we have a confirmed low on the oil chart. I also look at why or what other points of macro interest would be a reason for this structure to fail. Like right now, I am anticipating, everything's telling me we're going higher, but anything can happen in trading, guys. Like just because you have to be very adaptive. Even when I have a long-term plan, every week I am updating it. You can't just make the plan a year ago and just still follow the same plan and expect it to go smoothly. Things happen, just like in any trip you do, any vacation, there's going to be little bumps in the road that you might have to adapt or switch gears or something, okay? Anyway, so when we look down here, we have this huge liquidity gap and this unmitigated block, right? So that gives me a reason, okay, if we are gonna go down here, and this is where I save my 60%, and this is why for my 40, I have one more 20%, and then I have my last 40% of capital allocated. I have, for my last 20, let me zoom in. I think I have a place I'm looking at. This internal block right here. I'm not looking to add anything until we start filling this order block, and maybe on the pullback. If I see something like this, we start going higher, and then we start rejecting down, and then we get a break, and we continue higher. I will add my last 20. And then I will add my last 40% after that 20 when we break out of this high. This high right here, we break out of it and then we start accumulating down here, boom. That break will be my last 40% entry. And I'm taking guarantee target, I'm taking guarantee profit at the high of the range. Because remember, my last 40%, I always want to take it out the fast, okay? Because I want that 40% to grow the fastest, and I always keep 60% position in, and then put my stop to break even, okay? And even in my Notion, in July 13, about like 20 days ago, remember, just because I haven't been posted does not mean I'm not over here active, right? I think oil was right here. Yes, oil was right here. This is that candle. What did I say in my post? So I was either anticipating that we were gonna continue down and accumulate more and go higher, or the second option is looking like it's about to happen, where we go to the value area low. I don't have it posted up here, but we go up to this order block, which is kind of where the value area low is at, and then we start accumulating down here. So right now we are kind of accumulating. So like, if you could see on this picture, I'm seeing like a downward kind of like, I think it's called like a bullish flag break of structure. So if I see that, you can see we are kind of going down. We kind of have that break of structure now. So I'm gonna start looking to, you know what, just so you guys know I ain't bullshitting, I'm gonna add a little bit because it's not looking too bad here. I'm gonna add just a little bit into my position right now. Not like, I'm gonna add the 10% of that 20. So, okay, I'm connected. Now I'm gonna add 50 USD. Boom, added 50 to my position. And now what I'm gonna be looking for to add the rest of my 20% now, since I added that. Same thing, once we fill, because remember I added my $50 here. So once we hit this order block, and we start accumulating down here again, get another break, I'm adding the rest 10%, completing my 20%. Or if we just completely break out of here with strength, I'm guaranteed adding my last 20% here, and then waiting for that pullback again to target the high of the range, because the range high is pretty nearby. So consolidate or bullish flag, then add my last 60%. Once we reach range high at 110, I'm gonna take guarantee 25% off and put my position into break even and just letting it ride. Or this we could completely reject and come down to the last order block that I was looking at, which was in this range before we break structure, and then we go down to tap that possible last area of interest from that gap and that last unmitigated order block. This zone right here, if we just break underneath, because these are ugly lows, a bunch of equal lows, we can easily do something like this. Boom, boom. And then right here, I'm adding the rest of my position in, okay? And one thing I want you guys to kind of analyze or to take in when I'm kind of explaining my if, thens, and that's, is that I usually have 3 paths whenever I plan a trade, and 3 areas I'm either gonna add, take profit, or whatever it is. It's good to do that, and I know it could be very annoying hearing all these influencers or these people saying, well, it could go up, it could go down, which is like, as the sad reality, yes, I don't have data, like I don't have Excel charts, or I don't have Bookmap, or level 1 data, level 2, all that fancy stuff that you gotta pay top dollar for to get that data. This is what you're gonna have to do, you know, like you can only do so much with the indicators that gets provided on TradingView and Price Action TA, right? And the simple, the better, guys. Don't have too much things, indicators, or too much different ways on looking at charts. They all work. Whatever strategy, whatever indicators, you could be a successful trendline trader. You could just do shapes and do whatever the fuck you want. But again, what makes a pattern work is the fundamentals, what is going on, sentiment. The difference between now and then is that now people are focusing on data and fundamentals. When the bull market was going up, is that people was all hype. Whenever you could see that the sentiment is frothy and people are hype, then that's when you can now justify like, hey, this flag is gonna break because to the upside, because we are in a bull market, sentiment is hype. Okay, always put other things to it rather than just like, oh, this is an order block because this is where banks or whatever buyers stepped in. How do you know buyers stepped in? You know, like why would they step in? You know, and then that's when you start getting faked out, where you buy into an order block and completely invalidates. It might go up, it might get a little bounce, but completely shits the bed. All right. So in conclusion, guys, this is my oil hedge update. You do not have to follow my trade. If you like, you can. But one main thing I want you guys to take away from this video is that how I structured my my trade idea and how I not only was it, oh, the chart looks bullish and everything looks good for the upside. I backed it with fundamentals. I backed it with what the sentiment is, and more importantly, if it makes sense from our portfolio. If since I have a decent chunk still in high risk and I just have a good chunk of it still in cash, I think I'm like 40% in high risk right now, which is still a good chunk. I still also don't want just my cash not doing anything, right? So why not, since I'm already seeing the signs of the high risk assets are going to start going to a contractionary phase, why not take advantage of that? Okay, so now whenever the contractionary phase is over, things start recovering, I have a lot more capital to play with and my positions could be bigger, okay? Because remember, and the way that you see me trade now is for leverage. How I trade investing in stocks is completely, investing in spot, completely different. Everything you see on this channel will be with a leverage trade. That makes sense. Okay, and please go to my YouTube. Please go to my YouTube, subscribe. I'm gonna be back doing this now. I know I've been slacking for a minute now, but I have everything set up. I've successfully moved. I'm all settled in, and now you're gonna be seeing more of me.